This video covers order types, orders that you can place with your broker. I'll first introduce some terminology briefly that'll help us understand the concepts, and then I'll discuss the mechanics and strategies behind 4 types of orders that are out there. There's others, but these are the main ones that we should consider. And once you get a handle on these 4 types, the others will become quite easy and you could adapt to them when you see the definitions. So let's move on to paper and pencil. Okay, the first term that we want to look at here is momentum. And momentum basically means, in terms of the stock market or a particular stock is going up, it has inertia. And so when the stock market keeps going up, it has inertia, and so people anticipate it going up and continuing to go up. Okay? There's nothing special about that. Nearly anybody, you take a third grader and you show them this line and you ask them to forecast out into the future. Look, where is this line going? They're going to tell you this. Okay? But that's nevertheless the concept of momentum, that there's some type of energy behind the market going up. It's probably related to fundamentals, meaning that the economy is strong, so earnings are strong and cash flow are strong, and that's what's causing things to go up. You can also have momentum going on the downside. And if you're right here at this point in time, you'd be anticipating things to come down further. There's the concept of a contrarian market, and a contrarian market is, or if you are a contrarian, is the market's going up, you expect, and you're right here at this point, you expect it to go down. You expect it to do the opposite of what it's been doing. And if the market has been going down, you're contrarian, you're going to expect it to go up shortly. Okay, so it's momentum. That's a contrarian strategy or idea. So momentum, stock prices are going up, and so when you do a buy order, for example, when there's momentum, you actually add momentum to the market. When you're buying, when the market is going up and you're selling, that selling puts downward pressure on prices, and they tend to move down a bit. Not as exaggerated as this. If you're an average small investor, your impact on the market is going to be negligible. But if you're a large mutual fund or a hedge fund, I'm selling millions of shares at a time, that selling puts downward pressure on prices, and they tend to move down a bit. Not as exaggerated as this. If you're an average small investor, your impact on the market is going to be negligible. But if you're a large mutual fund or a hedge fund and you're buying millions of shares at a time, you can move prices up or down a bit. On the downside here, the market is falling because there's selling pressure. It's putting downward pressure on stock prices. And when you see that downward pressure as a contrarian, you're going to buy and put a buy order. That's going to put some upward pressure on the stock, however small it may be. Now let's look at the concept of a resistance line. A resistance line looks something like this. Say we got a stock price at a nice round number. You're starting low compared to this nice big round number. And here's what's happening. You're down here and the stock market is rallying. It's rallying, or a particular stock is rallying. That means it's going up. Okay. But what happens is there's a whole bunch of people who are down here and they're saying, when that stock hits 100, I'm going to sell. And so what you see is there's momentum that's driving the stock price up. And then all of a sudden, there's a bunch of orders to sell that will push the price down once it hits 100. And, it may drop a bit. But then, if the trend is still strong, then this may actually bounce around, but it'll eventually continue going up because fundamentals are strong. It just temporarily hits a resistance line. Okay? So that's the idea of resistance. Then there's the idea of a support line. And a support line, the way to look at it, again, this is price, is you're starting up high, above a big round number. And there's a bunch of people who are watching the stock fall and they say, If that stock falls to 100, I think it's a good buy. I'm going to buy it. So what happens is the stock falls, hits 100, maybe even goes through it a little bit. But the buying pressure is going to put upward movement on the stock price. Just a little bit. It'll bounce up this way, and it may bounce around for a little bit. But if fundamentals are deteriorating, meaning earnings, cash flow, and the economy are falling off, it'll just hit this resistance, this support line temporarily. And then it'll keep going on its way. So these are two very common concepts that you hear in the stock market, and the same with momentum and contrarian strategies. Very common terminology, and I'll refer to this terminology when I talk about order types. The first order that I want to cover is a market order. And these are the orders that people put in. They don't even realize they've put in a market order. They just put an order in to buy a stock, and it's going to be a market order. A market order is an order to buy a stock or to sell a stock at the next best available current price. So you're using a broker. Your broker is obligated to try to get you the next best available price. And when you're buying, the next best available price is low. And when you're selling, the next best available price is on the high side. Okay? Now, market orders are interesting in the fact that there is execution certainty with these orders. These orders will happen. Okay, so you put the order in, it'll happen. You don't specify a price. There's no price you give. You just say, I want to buy. And what's going to happen is you're going to get the stock price, or you're going to buy the stock or sell the stock right around where the order price is, unless the market is highly volatile. But that market order price is going to be fairly good. But the problem is it's not totally safe, because you have price uncertainty. You really don't know what's going to happen in terms of, put your order in for a stock for $30, and you're not the only person in the market. There could be thousands of people at the same time trying to buy a stock, especially in the morning when the market first opens, or in the afternoon when the market is about to close. There could be thousands of orders. So your order gets put in a queue. And then will get executed. And by the time it gets executed, the market may have gone up or down significantly. So market orders have risk in terms of price, but they'll get executed. Now let's move on to another type of order, and then I'll compare and contrast the two. The next type of order is a limit order. And a limit order is an order to buy or sell at a specific price or better. So if you're looking to buy, a price or better means lower, and if you're looking to sell, a price or better means higher. Okay? Suppose you want to buy a stock, and the stock right now is at $40. You could put a limit buy order at, say, 37. So what you're saying is, look, here's where we are now at 40, and you're saying when the stock goes and hits 37, you want to buy it for $37 or less. So $37 or less is what it'll be transacted if it ever hits 37 or less. So with a limit order, you have execution uncertainty because you don't know whether the order will ever be executed. The stock could go up, and you're never going to buy it for 37 or less if the stock goes up. So you get execution uncertainty, but you know that you're going to get it at a certain price or better. So you get some price certainty there. It's this price or better if the order actually happens. If it's a sell order, let's say the stock's at 40 now, and you own it, and you want to sell it. Well, you could sell it at 43, or you could put a limit order at 43. So when you place limit orders, you have to specify a price. On the software that you use with your broker is when you fill in this little dot here, it's going to open up a box. And in this case, you're going to put a 43 in there and say, look, that's the limit sell price. So if the stock is now at 40 and it hits 43 or better means higher for a sell, then the order will be executed. If the stock tanks, you'll never get to sell it for 43 or higher because it never hit that limit order. Also, when you do a market order now, there's no box opens up because you're saying, look, I want the order to take place You don't specify the price. They'll tell you what the price will be when the order gets executed. Limit orders are contrarian strategies. Limit orders are contrarian strategies. Let's take the example of the limit sell at 43 when the stock is at 40. When the stock is going up and hits 43, you're putting a sell order in, which means you're putting downward pressure. The pressure seems to be going up, pushing the stock price up. You're selling and you're pushing, putting some pressure on the stock to go down on your sale transaction. On this limit buy order, the market's falling and you're placing a buy order at 37 or less. You're putting a little bit of pressure going up. So you're acting in a contrarian way when you put in a limit order. Now let's look at what's called a stop order. Stop order is an order to buy or sell. It becomes a market order as soon as the stop price is hit. Okay, so you fill in the little dot for a stop order on your brokerage website. It's going to open up a little window and you're going to have to put a price in there. That's called the stop price. Once that stop price is hit, the order becomes a market order, which means it's the next best available price. The stop order price is basically a trigger, and it triggers a market order, which means you get price uncertainty, but you get order execution provided the stop price is hit. Stop orders are often called, there's a form of stop order called stop losses. Just plain stop loss order. And what that means is, let's say you bought a stock at 100. You might want to put a stop at 90, a stop order right here. So you bought right here at 100. You put a stop price right here at 90. What that means is it's a stopping a loss. So you bought it at 100, and if it drops and you lose $10 here, it'll stop the loss from happening, any more of the loss from happening below $90. So anything below 90 will get chopped off for the most part, because again, it's a market order now. And the market order means the price that gets transacted could be a little bit above, could be a little bit below. Just like with a market order. Market order is the next best available price. It could be a little bit higher or a little bit lower. And the same thing with a stop order, since a stop order turns into a market order once the stop price is hit. Stop losses also occur with short selling. So when you short sell a stock at 100, you might want to put a stop loss on at 110. So if you sell at 100 in a short sale, the market goes up, you lose money, and you want to prevent any future bigger losses, you get out of the transaction, and that's a stop loss. That turns out to be a stop loss buy, whereas this was a stop loss sell order. Okay, so that's a type of position to try to reduce losses. Stop orders add momentum to the market. So look, you bought the stock at 100, it drops to 90. You're going to put in a stop sell order, stop loss sell. That's going to put more pressure, downward pressure. So that's adding downward momentum. If you shorted the stock at 100 and the stock's going up, and you put a buy order to cover your short sale, then that's going to be continue to put upward momentum on the stock. Now, what's interesting is in 2005, we had a really wavy market. And people put these orders in. Like, let's say you bought a stock at 100 and you put in a stop price at 90, right? What happens if the stock really drops fast and it goes down to like $70 a share? That means you bought it at 100, you put in a stop at 90 to sell it, but the next price that actually materialized was 70. Wow, that's a problem. But that can happen in an extremely volatile market, and that's what happened in 2015. And so since stop orders add momentum, researchers suspect, and traders suspect that these stop orders were causing massive volatility, causing the market to go way up because it was adding momentum and way down in terms of sell momentum. And so the New York Stock Exchange and the BATS exchange, which is a totally automated exchange, stopped accepting stop orders in 2015. Now, your broker may still take those stop orders and work them internally, but the orders won't be executed on the New York Stock Exchange or the BATS exchange. But like I said, you still probably will have this little button here to fill in for a stop order. It'll just be done internally by the broker. The broker's computer system will keep track of it for you. Professionals tend not to use stop orders because they're watching the screens like all day, the whole 9:30 to 4 o'clock in the afternoon. They're watching their stocks. They may not even go to lunch, and so they don't necessarily put in stop orders unless they have to get away from their desks. Okay, so we just covered 3 types of orders. We covered a market order, which means you're going to get the stock at the next best available price. Could be a little higher, could be a little lower than what you thought and what you saw quoted on the market. Okay, and then we covered a limit order, and the limit order gave you a certain price or better if it gets executed, whereas a market order for sure gets executed. The price is uncertain, but with a limit order, once the limit is hit and it's reached, you're going to get that price or better, so you get some price certainty. But the order may never get executed because the price may never become or better. You can't have your cake and eat it too, basically, is what I'm saying here. Then we just covered a stop order, which when the stop price is hit, it triggers a market order, which means you're kind of right back to square one with price uncertainty there. But your order will be executed once the stop price is hit, and if the stop price is hit. Okay, so you can wrap your head around that fairly easily. It may take a little while, but I'm going to throw another one on top of the pile here, and this one is conceptually a little bit more involved. Okay, so what I want to do here now is I want to cover a stop limit order. It's a stop limit. So actually, if your broker has this, not all brokers will have that, and you fill this little dot in, you know what's going to happen? 2 windows are going to open up. One for the stop price and one for the limit price. So you need to specify two order prices. Okay, stop limit orders are initially stop orders that become limit orders when the stop price is hit. So when this stop price is hit, it becomes a limit order, and then you need to specify the limit order price. It's kind of like a compound order. Now, let me give you an example of a stop order, stop limit buy. It happens to be consistent with the resistance line concept that I showed you before. So here we have a situation where we have this nice big round stock price. So people tend to trade at big stock price, nice round numbers. So when people put orders in, and they actually put limits and stops and all that, and they make transactions or they plan on what they're going to do, they often do it in terms of nice round numbers. They don't look at it and say $99.67. I mean, some traders do that, but a lot of them don't. So a lot of the volume takes place on these big round numbers. So we have a resistance line. So remember what a resistance line looks like. You have strong fundamentals going up. The economy could be strong. The company itself could be strong, positive cash flows. But when the stock goes up, there's people sitting here saying, when the stock hits 100, I'm going to sell. I'm going to get out of it. So it's going to cause some downward pressure on the stock, and it may oscillate for a while, but then fundamentals will continue. And so it's going to continue up. So if you have this idea in your mind, knowing that, look, fundamentals are strong, but you also realize that there's resistance along the way, then you can take advantage of this. You can put a stop price at 100. So you're down here. What you want to do is, what's happening is when this hits a resistance line, it's basically confirming a trend that it's going to continue to go up. So you say, look, once it breaks through this 100 mark, there's going to be some resistance, but the fact that it broke through 100 means this trend is confirmed. That's what's in your head as a trader. And so you put in a stop at 100, which means that it's going to trigger a limit order. But you need to specify the limit price. So let's say the limit price is at 99. So the stock goes up, hits 100, and then you're saying, I want a price of 99 or better. And so, well, this is not 99 or better. This is not 99 or better. So when you get down here, this is 99 or better. So right about there, your order is going to get executed. And basically what's happened is the trend has been confirmed because it broke through the $100 mark. But you got the price at $1 lower than what you could have otherwise. And so that's the key to this. You get this spread, you get this discount of $1 in this example. You can have a support line. So by the way, this is a stop limit buy order. Okay, this is stop limit buys. With a support line, you're going to have a stop limit sell order, which is going to be consistent with it. So you got the nice round number. You're starting them up here. You're thinking this is what's going to happen. So you, as a trader, you think the fundamentals are going to continue to deteriorate for the company or for the economy. But you know that people are going to say, look, when the stock drops to 100, I think it's a good buy. And it's going to put upward pressure on the stock. So what happens is you put a stop sell at 100. Okay, so when it hits 100, you want to sell. And you could put in a price, the limit price of 101, for example. And when the stock hits 101, you'll get the order. The order will be executed because you're going to sell it at a bit higher up here. And again, when it hits this support line, it's confirming that this trend is going to continue. So that's a stop limit order. So notice the stop limits are adding momentum to the market. In this example, the stock is falling, falling, falling. And what are you doing? You're selling. So it may hit some resistance, but ultimately, in the big picture, you're adding to the momentum and volatility in the market. So now the question becomes, and I'm often asked, is what's the difference between a limit buy, for example, and a stop limit buy? What's the difference between a limit buy, and you put a limit price in and you want to buy, versus a stop limit buy? And the answer depends on where the current stock price is relative to the order price that you're putting in. So when you do a stop limit buy, for example, we have a resistance line. The stock starts from down below and is going up. So that's the difference. Because when you do a limit says, look, the price is here, it's going to fall. I want to buy it at this price or better. This price or better. So with the limit buy, you're starting up here. With the stop limit buy, you're starting down here. And then it's reverse. Well, actually, I should do it over here. It's the opposite here with a stop limit sell versus a limit sell. So now, let me twist your mind just a little bit more with concepts that we've already looked at before, terminology-wise. And so I want to get at the concept of a marketable limit order. So here we have a limit order, and here's the example that I was showing you like 100 pages back in my notes here. Did a limit order. And I said, for example, look, if the stock is at 40 now, we can put a limit buy at 37. That means you're going to get the stock at 37 or less. This order is not in the market, so to speak, because the price is at 40 and you're waiting for it to drop to 37. The other example that I gave is the limit sell, where the stock is at 40 and you're going to sell it when it hits 43, if and when it hits 43, for 43 or more. These orders were not in the market, but with a marketable limit order, I could put in an order, say, at 41, a limit buy. Okay, so notice what happens here. The stock right now, we're at 40 right now, and I'm saying I want to buy at 41 or less. the market is already at 41 or less. So this order is going to get executed at 41 or less, probably around 40, but if it's in a highly volatile market, it's possible the stock jumps up and the order doesn't transact, or whatever. What's going to happen is, you can actually pay a higher price right up to the $41 mark, but you're going to pay something 41 or less with a limit buy. So what you're doing is you're putting a cap on the price that you're going to pay. Now you can do the exact same thing. Let me get a black marker here. The stock is at 40 on the sell side. So 40, I said 43, that's a non-marketable limit order. At 40, I could put in a price of 38. And I'm going to say, look, I want to sell at 38 or more. And look, the market is already there at 38 or more. So this order will be executed unless somehow the stock drops tremendously right through this $38, in which case the transaction doesn't take place. So that's a marketable limit sell order in that situation.